If you have even $1 in your pocket, you're carrying around something that people could never get from all the gold coins they used for money in the past. Sometimes I go to a convention where everybody gets a box lunch. And sometimes I can trade a cookie for some extra potato chips or something like that. Well, back when people were using gold coins, it wasn't much different. There was the barter system. You trade a product for a gold coin. Everybody likes gold. This has value in itself. And that makes it a really bad choice of money for a growing economy. To see why that's true, I want you to think about all the products that were bought and sold in terms of dollars in 1950. It doesn't matter if it was cash, check, credit card, wire transfer, as long as the price was in dollars. I want you to think about all those economic transactions. Well, today, the value of all our economic transactions is about 12 times that high. So how many dollars do we need? Well, we need at least 12 times as many dollars as we had in 1950. It's actually a little more than that because of inflation. Now let's think about how much gold we have today compared to 1950. Do we have 12 times as much gold? No way. The gold miners are digging gold out of the ground as fast as they can, but the supply of gold is never going to grow as fast as we're growing our economy today. Now, theoretically, we can still use a gold standard if we just reduced all the prices as we become more productive. And theoretically, we can have the prices either rising by a standard amount, that's inflation, or falling by a certain amount. As long as it's consistent and it's not too high, we could do all our calculations, financial calculations that way and just factor it in. But in practical terms, inflation is very different from deflation. A little inflation, like we have more money, that works pretty well. A little deflation is a disaster. To show you why that's true, I want you to think about making some major purchase of something expensive. If you see that prices are going up, you'll probably buy that new that product as soon as you can afford it. But if you see that prices are going down, you may wait for a while and see if you can get a better deal on it. What's worse is that when prices go down across the board, then wages have to go down. But we have a lot of long-term loans, such as for a house or a car. Now, if you have a home mortgage, that's based on that original price of the house. It doesn't go down when other prices are going down. But your wages are going down. Your salary is going down. So you may not be able to afford to make the payments on your house or your car. When people stop buying things and they stop making payments on their loans, the economy starts grinding toward a halt. We don't want that at all. Money is something like blood. It has to circulate to keep the economy healthy. And just as the heart pumps blood through the body, banks circulate money from one part of the economy to another. When we have deflation, that rewards people who save their money in a mattress. Or, in previous generations, they would just collect gold coins. When you have your money sitting around in the form of gold, or in the mattress or whatever, then it doesn't get used to keep the economy healthy. And when you put the money in a bank, on the other hand, you can earn interest that is higher than the rate of inflation. So you make a good deal. And also that money is available to people who want to borrow it to buy a house or buy a car or to expand a business or to start a new business. The Federal Reserve is responsible for keeping our money supply reasonably stable. And that's a tough job because things change all the time. New products come out every day. The trade agreements with countries all around the world change. The weather changes. The harvest of almonds may not be very good this year. And sometimes we have major catastrophes like hurricanes or COVID. So the Federal Reserve collects tons of data on the economy and uses that to decide how fast they want the money supply to grow. Here's the basic equation. The price level times the gross domestic product per time period equals the money supply times the uses per time period. Now that's what we were thinking about with comparing 1950 with today. The time period can be whatever you want as long as it's the same on both sides of the equation. The uses per time period is also called the velocity of money. And that represents the same dollar can be used for a lot of transactions throughout the year, sometimes throughout the day. Now, a lot of times we hear about governments printing money. Well, most of our money is in the form of just numbers in bank accounts. Although the Federal Reserve does send print orders to the Treasury to get money printed. You can find that on their website. I think it's kind of interesting to look at. And here's a chart of the historical print orders. There have been times in history when governments printed way too much money. And then it really wasn't worth anything more than the paper it was printed on. Here's a few examples. That situation is so unstable that it doesn't last for very long. So central banks around the world have a very strong incentive to keep the money supply stable. The Federal Reserve aims for an inflation rate of about 2% per year so that we don't fall into the deflationary zone. They don't want the inflation too high or too low. Now, the U.S. dollar has been the primary reserve currency of the world since 1944. That happens because we have a secret ingredient, which is the information about the economy. And we do a really good job. It's not perfect, but we do a really good job compared to everybody else in the world. Sometimes we talk about something that's good as gold. Well, in terms of keeping the economy running, our dollars are even better than gold. Thank you for watching.